Hello traders, I hope you managed to get a good refreshment, managed to chill, relax, and you're ready for chapter 2 of our basics. We have a lot of ground to cover, so for some of the things we will not be spending too much time on them because I deem them easy concepts to grasp. And then the concepts that may be a little more complicated, we're going to spend a little more time on so that we don't have a long chapter. Okay, let's do this. So first, let's talk about reading Forex pairs. Right. The first thing you need to know about reading Forex pairs is they are named in a standardized way so that the quoting of prices is similar and standard globally. So in a pair like Euro USD, you can't then call it USD Euro. Well, of course, you've got freedom of speech and you can do whatever you want and name it whatever you want in your own house. But the moment you meet some seasoned traders, I promise you, you're going to look like you don't know what you're talking about. So each pair is named a certain way, and for that reason, you just have to name it the way that whoever standardized these things chose for it to be named, right? So the first currency is always what we call the base currency, and then the second currency is what we call the quote currency, or we can also call it the counter currency. All right. So let's talk a little bit about some terms that surround buying and selling of currency pairs. You hear traders say, I'm going long, or I have a long position, I have a long entry. What are they talking about? It's simply synonymous for saying, I have bought a currency pair. So if you hear a trader say, I'm long Euro USD, they've simply bought Euro USD. The opposite is also true. When you hear a trader say, I'm short Euro USD, or I have a short position, or I have a short entry, what they're simply saying is they have sold a pair. All right. Now, you also hear of words like bulls, bears. You may have heard of these terms. Now, it's a simple analogy of the ongoing battle that's between the buyers and the sellers. This uh, ongoing battle is because at any price point or at most price points, as long as price is moving, you've got buyers who believe that price should go higher and you've got sellers who believe that price should go lower. So because of this fight in quotes, there's an analogy that represents them that's commonly used, which is a fight of bulls and bears. The bulls are normally used to depict speculators that are going long, whilst bears are speculators that are going short. When the market is going up, it is called a bullish market, since bulls are clearly winning against the bears. And when the opposite is true, it is called a bearish market, meaning the bears have managed to tramp over the bulls, or the sellers are winning over the buyers, which is why the price is being driven lower, right? This is a very simplified way of thinking of these things. Now, I want to remind you a simple analogy that we used. Let's all keep that traveling analogy in our heads we used in chapter 1, where we talked about a guy traveling from the United States of America to the United Kingdom. Now, I need you to remember that for this guy to buy pounds in the UK, to buy pound in the UK, sorry, you may hear me say pounds. I don't know where I got that. I'm trying to delete it off of my head. But when you are in the UK and you're trying to buy pound, you need to have a currency that you're selling. All right? And this validates what we said earlier, that each time you buy a particular currency, you simultaneously sell another. So this also happens electronically when we trade Forex. Because when we are to consider a pair like Euro USD, when you buy the USD, you are simultaneously selling the Euro. So the bid is the price at which your broker is willing to buy the base currency in exchange for the quote or the counter currency. So what does this mean? It means in our earlier example of the traveler, when they approach the bureau de change, the bureau is obviously going to say, there is a price at which we can buy your US dollars to give you the pound. And they are going to offer him that price, to which if he is to go on with the transaction, he needs to agree to the price. Because they're not running a charitable organization, they're a business. And in the markets, brokers are doing the same thing. They're linking us to the markets and they're executing trades and doing whatever on our behalf. But In the process, they want to make some money. So they say, this is the price at which I'm going to buy that euro from you if you want the US dollar. And the opposite is true. They have what we call the ask price, which is the price at which your broker will sell the base currency in exchange for the quote currency. Okay? So the difference between the ask price and the bid price is what we call the spread. This is the difference between the price at which the broker is willing to buy a base currency and the price at which they're willing to sell a base currency. So for some brokers, the spread is how they make money. It's not for all brokers, but for some brokers, they make money by taking the difference, which is called the spread. Now, the spread can fluctuate for a variety of reasons. I will cover the main ones which I think are critical for you to know. Number one is liquidity. Remember when we were talking about those Forex trading sessions in chapter 1? Now, imagine a scenario where a trader is to come into the markets at a period of low liquidity, or let's say in a period where there are few buyers and few sellers. What would happen? You are likely to come across high spreads. And since trading is a business and the spread is a cost to us, we want to keep our costs very low, because if you do not manage those costs, you might end up not making the money that you think you're going to make, especially if you are trading very, very low or short time periods. Let's put it that way. Right. So let's imagine a scenario where we say the highest volume is between the Asian, London, and the New York session, right? When the New York session ends, before the Asian session starts, you are likely to encounter very low liquidity, which in turn means you may face higher spreads. Now, for you to understand the relationship between this liquidity and spread, I'm going to use a very simple example, which is very oversimplified, but can give you an idea of what will be taking place. So let's say you're in the business of selling clothing items. You sell t-shirts. When you buy those t-shirts from your supplier, you are happy to buy them if you know there's a high demand for your t-shirts. So if you know that this is the only shirt like that in the world, and everybody needs it, maybe legislation mandates that everybody should have a blue t-shirt, you know that everybody and anybody can be your client. So you're happy to buy, and you're happy to lower your price because you can make money from economies of scale or volumes. But the opposite is also true. When you're stuck with a lot of stock from your manufacturer and there is not enough demand for those t-shirts, you may find yourself in a situation where you've got high costs but very little income, and you need to cover those costs. So what do? You may end up simply raising the price of the t-shirts as a way of making sure that those who demand it, even if they are low in numbers, they can at least help you to cover your cost margin. Now, let's talk about volatility. Volatility simply describes a situation where we have a price change over time. If we have high volatility, we're simply saying we've got a high price change over a short period of time. And the opposite is true. When we say we have low volatility, it means we've got a small change in price in a large period of time. Now, theoretically, you might think as a trader, you want to come into the market and see a very large price change in a short period of time so that you make a lot of money in 5 minutes and you close your trade and you're out. But you need to know something. These periods of high volatility don't necessarily mean the volatility is happening in a particular direction. Price may be changing in all sorts of directions. Up, down, up, down, up, down, up, down. In the grand scheme of things, price may not be progressing anywhere, but it's making big changes in the same place. It's going up and then immediately down. And this is not a good time for any trader or investor to be in the market, because they can easily lose a lot of capital in a short period of time. Periods of high volatility normally come and they're associated with news releases and economic events that can cause traders and investors to be cautious about how they uh, manage their money. So, for example, if key inflation or interest rate news is about to be released, investors and traders are more cautious towards the news release because they are not 100% sure what's going to happen to the market. So, they do not want to be there when the volatility is taking place. Now, you may ask, how does this volatility connect with spread? Because these traders and these investors, particularly that are trading large sums of capital, have decided to stay out of the markets during periods of high volatility. It means consequently you may have lower liquidity. And because you've got lower liquidity, you may end up having or incurring higher spreads. I hope this has been clear for you. So if you look on the picture on the right, you see that the difference between the ask price and the bid is shown below. The 3 points, that is what we call the spread. Okay? So let's talk about what a pip is. A pip is usually the last decimal place of a price quote. Now, if you look at the image that's below in this slide, you see that we've got 5 digits after the comma. This is not always the case that all currency codes will have 5 digits after the comma. Sometimes you may incur 4 digits, and in some cases even 3, as with JPY pairs. But how you need to think of a pip is simply a measure of the change in price. Just like how meters or miles are a measure of a change in distance, pips are a measure of a change in price. So when you hear a trader saying, I bought Euro USD and it moved 30 pips in my direction, what they are simply saying is that price moved a certain degree of 30 units in their favor, right? And I'm going to show you how to count those pips. Now, if you look on this number, 1,12971, the last digit to your extreme right is what we call a pipette, which is a fraction of a pip. And then the 4th digit after the comma, second from your right, is what we call the pip. So if we were to count the last 2 digits, we see 7 pips and 1 pipette, right? If we were to include the last 3 digits, we'll see that the 3rd number from your right are also pips counted in tens. So we would have 97 pips and 1 pipette if we were to count the last 3 digits only. I hope we're still together. Now, if we were to count the last 4 digits together, we would have 297 pips and 1 pipette. I hope this is as clear as possible, right? Now, in cases where we've got 4 digits after the comma, which is, I believe, the most common case, the last digit on your right would be your pip. So it would simply mean that that code does not show pipettes. That's easy, right? All right. So for your JPY pairs, all you need to know is if they've got 3 digits after the comma, that the second digit is normally the pip and the last digit is the pipette. All right, let's go. Now we are going to talk about lots, margin, and leverage. It's going to be a mouthful and a ton of definitions, right? I encourage you to pay attention and do further study of your own to understand these things thoroughly, right? You need to understand them because they're the basics of how we make money in the Forex market. At the end of the day, if you do not understand it, honestly speaking, I've seen traders who make money from the Forex market without understanding these things. Yes, I tell you the truth, but it is better to have an understanding of how things work. So let's start by talking about lots. So, you know me with, I'm sure you've caught on now that I used a lot of oversimplified examples to make it relatable. So let's say you go to a grocery store and you want to buy some tissues. In most reputable grocery stores, or let me not use the word reputable, but let me say in most of the larger grocery stores, you will find that you may not be able to buy a single roll of tissue paper. Why? Because they sell them in packs of maybe 4, 8, 12, 18, or whatever denomination they choose. But the key to note is they sell them in packs. If I'm to use another example that was once relayed to me as well, it was an example of eggs. When you walk into some of these larger stores, You cannot buy 3 eggs or 7 eggs. Maybe that's exactly what you need at the time, but they're only sold in maybe sets of half a dozen, or maybe a crate of 30. So currencies are sold in more or less the same manner. They come in lots. So you may have 1,000 units, which are called micro lots, or you may have 10,000 units, which are called mini lots, or 100,000 units, which are called standard lots. So depending on your broker and the type of account you have, when you buy, you may be buying a micro lot of currency, a mini lot, or a standard lot. Now, let's talk about making money in the markets. One thing is for sure, you may have realized by now that you need large or big changes to take place in the prices of currencies for you to make large sums of money. But this is not always the case, because it's economy against economy. Every economy has got a vested interest in protecting the value of its currency, because like we said earlier, the currency represents a share of the country, and it says a lot about the value of the economic, political, and social status of a country. Now, that being said, it means since you are not going to get those large moves like the one that happened to our guy who traveled from the States to the UK, you're probably going to need a large sum of money so that even a small change can make a significant or give you a significant profit or loss. We need to stress that. Now, if you had $1 million, a 1% change in the currency, if you move from the States to the UK and back, a 1% change of that million, let's see if my math serves me right, but a tenth would be 100,000 and a percent would be 10,000. Right. So if my math is correct, if that rate changes in your favor, you can easily make $10,000. And in my head, that's a significant amount of money. Nobody will say, if you offer them $10,000 right now, they'll say, I don't need that. It's not a coin, right? But if you had only $100 and the change is still 1%, do you realize that you've only made $1? So the goal of most Forex traders is to be trading large sums of money so that small fluctuations add up to larger sums of money. So to be able to trade larger lots, you need larger sums of money than that you may not have. Unless, of course, you're a trust fund baby. No shade to trust fund babies, by the way. I wish I was one. But if you have those large sums of money, then congratulations. Sometimes you may not even need, large sums of leverage to trade. But if you do not have large sums of money to put at risk, then there's a financial mechanism that was put in place just for you. This is the principle of leverage. Now, I want you to understand something. Let's say you want to buy a standard lot, which is 100,000 units of a pair Euro USD, meaning you want to be in control of $100,000, but you do not have it. What is going to happen is your broker is going to say to you, look, I'm happy to lend you the majority of that 100,000 so that you can trade, as long as you can give me a good faith deposit. Let me just hold some of your capital whilst you trade my capital, so that if you lose my capital, at least I can keep this as security. But if you make money, I'm going to return this good faith deposit to you. This good faith deposit, ladies and gentlemen, is what we call margin. And we have got what we call leverage now. Leverage is a ratio to which they say we can let you control up to certain times the amount of capital that you have. Maybe 50 times, maybe 100 times, maybe 500, sometimes even 1,000 times. That leverage that they give you determines how much margin they need to set aside to open a position for you. Do you get it? If you don't, let's go through an example. I'm sure you'll get it. Now, for example, If the allowed leverage that a broker gives you is 1:100, in brackets, 1% of position required, and you wanted to trade a position worth 100,000, but you only have 5,000 in your account, your broker would then say, no problem, brother. Let's set aside $1,000 as a deposit, our good faith deposit, and let you borrow the rest. Do you see? They asked for 1%, which would be 1% of the amount of money that you want to be controlling in your position. And that 1% for you is now 5,000. Now you get to enjoy the benefits of trading or making money as if you were trading $100,000, although in your account you only have $5,000. What that means is your returns are magnified. If that 100,000 moves 10%, or 10% in your direction actually, it means you can easily make 10% of your account. But in a scenario where it moves 10% against you, I'm sure you're going to sleep and forget to remove your shoes, because your losses are also magnified. So I tell you one thing for free, that having leverage is something that is favorable if you're a skilled trader, but it's not necessarily a good thing if you're a bad trader. Now, let's talk a little more about this leverage. This leverage is more like a pivot. It's more like an instrument that allows you to trade more money with very little money. So this 1:100 ratio, which we translated to a percent and made to 1%, is the broker simply saying, if you want to trade a standard lot or 100,000 worth of this currency pair, I only need you to put up 1%. So brokers offer varying degrees of leverage. Some will go to crazy. I've seen like 1 to 3,000, which is, in my opinion, very, very high leverage. It means you can take in a lot of capital, but if this trade moves against you just a little bit, you can lose all your capital, right? So in the example above, the broker required a 1% margin. This means that every 100,000 traded, the broker just wants 1,000 as a deposit. So the 1,000 is not a fee. It's simply, as I called it, a good faith deposit. You get it back when you close your trade. The reason the broker requires the deposit is that while the trade is open, there's the risk that you could lose money. Right. I hope you have now understood the concept of margin and leverage. Okay, let's move on. Now let's talk about a margin call and a margin stop up. I hope you're not sleeping. I know I'm not quite an exciting teacher, but I promise you we're almost done with chapter 2. Okay? All right, let's do this. So in Forex trading, the margin call level is when the margin level has reached a specific level or threshold. Okay, so let's take it back to our example of 100,000. Now, let's say you're trading that 100,000 and they have that $1,000, our good faith deposit or margin. Now, they're going to tell you in their terms and conditions, the brokers, when they give you that money, they're going to say, look, when this thing starts to move against you, and we realize that you have reached 80% of your margin in the negative, we are no longer comfortable with where your trade is going. So we need to send you a warning. A warning just to say your margin level is now falling to dangerously low levels and is approaching our threshold, which we believe if it approaches, we'll have to close your trades. So if we are to call a margin call anything that is relatable, we'll just call it a warning. So typically on your broker, if you're going to be using brokers like MetaTrader, which we'll talk about more later, they're going to send you a notification on your phone. You're going to see some reddish color there to show you on the platform that your margin is getting to dangerous levels. You need to consider closing your positions manually. And if you decline to do so because you believe that price is going to turn in your favor, or your emotions have gotten the better of you, you're going to reach what is called a stop out level. And this is a percentage of margin where they say, if your margin percentage falls to this level, we have to close your positions to protect our capital. because we are happy for you to make money, but we are not happy for you to lose our money. All right? So all of this, by the way, is a very simple way of trying to articulate these things. So in Forex trading, a stop out level is when your margin level falls to a specific percentage in which one or all your open positions are closed automatically by your broker. Now, this is something that you need to consider when you're looking for brokers. You know, if you're that kind of trader who knows that you're trading a small account, then you need a broker that is more lenient. Maybe a broker will say, we'll send a margin notification or a margin call when you're around 80%. But when you reach 50%, we close all your trades for your margin level. So what you need to be doing then is you need to be looking for those brokers that will allow you more room to wiggle with the capital that they've extended you. Okay? This is particularly if you're going to be trading very, very small accounts that you know are easy to blow. I've witnessed traders who struggle to fund large sums of money or significant portions of money, let me say. So they may end up funding very small amounts of money, and they need to be right. You know, it's not a good way of trading, and I don't encourage it. But if you're going to do it, at least look for brokers that allow you more wiggle room. You know, if you have a broker that's not going to allow you those low stop out and margin call levels, then you're going to easily blow your account. In any case, you should not be blowing accounts. And we're going to be talking about how you can do that, right? So this liquidation of positions happens because the trading account can no longer support the open positions. So if you open, let's say you've got that example of 100,000, they extended to you. You have 5,000 in your account, but now because you chose to risk 1,000, which resembles 20% of your account on one trade, or even if you're greedy, you choose to risk all of it and you open 5 positions. And then that thing starts to go against you. Euro USD starts to dive and you've bought. You start to sweat, you start to pray, you start to call your wife, your husband, you do whatever you do. Maybe you when you're nervous, you like to lick your palm. You do all manner of things. And this thing just isn't going in your direction. What's eventually going to happen is they are going to start to close your positions forcibly because you declined to do it manually. So they will maybe close out 2 positions to the point where your margin may be resuscitated. And if this thing keeps going against you again and reaches that margin stop out level again, then they're going to eventually stop out all your positions. I hope this has been easy to understand. Right. Now, I think we have got a few more terms and then we're done. I know I promised, I was lying. Now I'm telling the truth. Right. Balance. Your account balance is the cash that you have available in your trading account. That's simple. If you find $1, that is your balance. It's like a bank balance, right? And then we've got what we call unrealized or realized profit or loss. Now, if you're in a trade and the trade is running, you funded $100,000, right? And then the trade is running and you are $10,000 in profit. What you have is an unrealized profit of 10,000. It is only realized when you close. So I'm sure you see screenshots of running trades on Instagram, on Facebook. Those are all unrealized. You do not know if that person closed that amount of money until they actually close the trade. That's how you know they actually made that money. And I've been in positions where I've had a high unrealized profit, and I thought that instrument would keep going in my direction, only to lose all that unrealized profit and come back to a loss, and then close a loss, which then becomes a realized loss. So what you simply need to understand is this is the floating profit or loss when you have running trades. It is yet to be realized when you close your trade. Equity. Now, equity is simply your balance plus your unrealized profit or loss. So if you have or you're floating a profit of $10,000 on a $100,000 account, you have got an equity of $110,000. The opposite is also true. If you have a loss of $10,000 on a $100,000 account, you have an equity of $90,000. Now, we've got what we call free margin. Free margin is the money that is not locked up due to an open position and can be used to open new positions. So if we come back to our example where the trader is controlling a $100,000 position and the margin that's been taken up is $1,000. The remaining $4,000 in their $5,000 account is what we call free margin. It is available for them to trade other positions. Maybe they see other opportunities in the Forex market. Right. Swap. Now, a rollover or swap fee is a fee that a trader can pay or earn if their broker closes an instrument while other positions are open. A good example of when this takes place is on weekends. Remember, it's a 24/5 operation. So during weekends, it's not running. But because you didn't close a trade, your positions are being held, and you are yet to see how your positions will perform when the market reopens on the Sunday or the Monday. So, because you bought a currency pair, it means there is an interest which is payable on the currency that you borrowed, and there's an interest that can be earned on the currency that is bought. All right. So, the difference between the two interest rates becomes the fee that is payable or earned. All right. So you'll find if you hold positions for long, maybe a swing trader, and you hold them over positions, you may find that fee appearing in your statement. This is a fee that they're charging you for holding or keeping your positions in the live market whilst the market was actually closed. All right. I hope that was clear. And we are now moving to chapter 3. So I know this has been long and there's been a lot of talking. Chapter 3 is going to be much shorter, much quicker. And I know you're excited to be getting to the part where we start talking about the money. You've been asking in your head, why are we still talking about these things? I'm not interested in them. Don't worry, we're getting there. So just grab a snack or maybe get something that you can start to do to refresh. Maybe you can just go through some of the notes that we've been discussing when we've been talking about chapter 2. And I'll see you in the next one. Cheers.